Looking for some new business right now? I'll bet you are if you're a loan originator. Well, come to our New Biz Toolkit webinar on June 20th at 11 a.m. Pacific time, where Angel Oak is going to give you all the scripting and all the tools you need to get new business out of builders, realtors, CPAs, small banks, and local credit unions. Everything you need, you're going to get at this webinar. Don't miss it. Click this banner you see right here over on your right.
Good morning, everyone. Frank Gray here with the National Real Estate Post, and I'm about to bring on one of your favorite people and mine, Barry Habib, once again. He's spending a lot of time on the show, and it's well worth it. We love him on the show, as I know you guys do. Barry, we want to talk today about a few things. We want to talk a little bit about that Fed hike that went down, a little bit about tariffs, because people are interested in that, and then we want to kind of close it up with some housing data. Why don't we go ahead and get started with the Fed hike and the tariffs? What do you got for us?
So great. Hey, first of all, it's so great to be on. Thank you guys. You guys are always so kind to me. And looking especially handsome today, Mr. Frank Gray. So,
whatever, Mr. Habib. Get to the good stuff.
So, hey, the Fed did hike. It was expected. That's no surprise. But here's what happened. There was a surprise in that they said, as far as the consensus goes, that they anticipate 2 more hikes this year, 3 more next year. That's a lot of hikes. And the market was not really expecting that. It took bonds off guard, but then bonds kind of recovered because you want to know something. The bond market kind of likes when the Fed hikes rates. I know it sounds crazy, but it curtails inflation. It keeps inflation in check, and inflation is the enemy of bonds because it eats away or erodes the fixed payment that you receive. So the bond market was okay with that. But what the bond market's not going to be okay with, we've talked about this before, beginning July, we're going to see another ramping down of the amount of Fed buying of mortgage bonds and treasuries. So remember, combined, they were buying $50 billion a month combined. In October, they knocked it down to $40 billion that they were buying, and we saw rates go up. In January of 2018, they ramped it down to $30 billion combined a month, and we saw rates go up. In April, they ramped it down to $20 billion, and we saw rates go up. So when they ramp it down in July, which is a couple of short weeks away, from $20 billion a month combined to $10 billion a month, what do you think is going to happen?
I think we're going to see things go up, Barry.
Probably a good bet. So let's be careful now. Let's be on guard for that. So that's most of the Fed story that we have. And I know that one of the other things that we see happening is you mentioned the tariffs. And
right.
What does that mean? You know, I think that what we have to understand is, look, the 2 big dogs in this one are the United States and China. And while everyone else is important, of course, I think here's what's happening. I'm not getting political. I just want to try and lay out what I see happening because I don't think the media gets it. So what the United States is trying to say is that there is a deal in place that is inequitable. In the United States' opinion, it is inequitable. So by putting these tariffs on, it will either make it more equitable or bring the other party to the negotiating table to try and rework things. That's what the feeling is, because they said it is so inequitable, we don't want to continue under these terms. Okay. Now, a couple of things can happen here. Could China come to the bargaining table? Could China say, hey, maybe we will figure something out? But from now China's perspective, it's a little different. They're saying, hey, we've been working under this agreement, so what you're doing is changing things. So maybe China says, well, if you're going to change it, then we're going to change it and ramp it up. And the United States has already said to China as kind of a warning, if you ramp it up, we've got more tariffs that we can ramp up too.
Wow.
And that's when you get into this escalation. Maybe that's what's needed to bring people together. Maybe it's not a good idea. I'm not saying if it's good or if it's bad, but what I do want to tell you, if it starts to escalate, we're already seeing import prices rise in the last report from last week. If that continues, it's another inflationary pressure, and bonds hate inflation. Wages are going up as well, inflationary. So I'm just saying, think about these things because it could cause rates to move up.
So we want to kind of keep our eye on that news going forward and just see where things kind of shake out. And when there's instability like this, where it's like, hey, you, me, that in turn is obviously it's already driving up import prices. But even just the notion of it can drive the market in the wrong direction, right?
Correct. 100% correct.
So Barry, we did a show last week, and we've been doing this a little bit, where we feel like, we're seeing housing kind of soften in some areas. We're seeing some listings creep into the market in the Pacific Northwest. They had a lot in May up there. They had 14,000 come in the month of May. suddenly they've got a little more listings than they had before. Things are slowing down, that type of thing. So Brian and I have been saying, hey, we might be seeing that. We might be sort of peaking here in some areas and seeing some things cool down. What's your take on that?
So look, real estate's very local. So there are going to be some markets that perform better or worse than others. But by and large, across the country, there's a housing shortage. There's no doubt about it. There's a housing shortage. There's a lack of inventory. And there's an ample amount of buyers. People do want to buy. When you take a look at the offset of what it costs to rent, it is typically very favorable to buy versus rent, especially if you're going to be there for longer than 2 or 3 years. It's almost always going to be better to buy versus rent, even in markets where appreciation has slowed to small levels because of what we use as leverage, because you're putting a smaller down payment down, and the compounding effect. So look, I'm very bullish on real estate, and it's just a demand and supply analysis of this. There are simply too many people with too few homes being built to support them in most parts of the country. Now, there are certain parts of the country where you have a greater balance, and in some, not many parts of the country where you might have a little bit too much inventory. I don't think that exists in any large sampling, but certainly if you're going to look at every single place in the country, there are going to be areas that have that. But if your market has a shortage of people buying homes, if you're in a market where people are coming in and inventory is tight, and there are multiple offers on homes when they're priced correctly, then you can be very confident that your market will continue to appreciate, and you don't need much to create enormous wealth. Now, that said, we also want to take a look at affordability, because this is often a topic that comes up, and we've discussed this in the past. Now, incomes are going up, but on a percentage basis, somebody might say, well, if incomes are going up at roughly 3% and homes might be going up at 6%, is there a disconnect there? I understand that there could be on the surface what appears to be a disconnect, but you don't use all of your income for your payment on your home. Because you use a fraction of your income, you get the benefit of leverage there. So if you used 20% of your income to cover principal and interest, theoretically, if real estate went up 5%, you could probably cover it pretty easily with 1 or 2% raise in your income. Now,
Gotcha.
Saying that that's the case in every area, and perhaps this is an oversimplification, but I want people to understand it's not a 1-for-1. There is a relative relationship between the two where you do have some leverage there. So you don't need the income gains. A 3% income gain is more than ample in almost all cases to handle a 6% rise in real estate. Some parts of the country are rising a lot greater than that. And unless we're seeing incomes rise, it makes it more difficult to see that affordability match up.
Gotcha. So you're still feel really strongly about real estate nationally. Overall,
extraordinarily bullish, as I have been for the past 6 years, extraordinarily bullish on housing. I know the media disagrees with this, but the media has been wrong. And the same factors that we have seen for the past 6 years are in place. Now, we're going to get a lot of housing data this week. And I think that although the media might try and put a negative spin to gain eyeballs, we want to break that down and really take a look at it. And if it starts to change, then we'll change, okay? Until the facts tell us differently, we're still going to remain bullish.
We're bullish. Okay.
When the facts change, we will change.
Got it. Good stuff, man. I really appreciate your perspective, as always, on everything, Barry. I'm sure our viewers do as well. Thank you very much. Guys, leave us your comments down below for Barry. He tries to get to them as best he can. He's a very busy guy, though, but he tries to get.
I will. I promise I will.
And then also, guys, I would highly recommend, if you have not looked at all the wonderful marketing tools and benefits there are to MBS Highway, you're just out of your mind. We'll put a link down below to MBS Highway. You can try them for a couple of weeks for free. But let me tell you, if you think this was good information, you ain't seen nothing yet. Get into MBS Highway, and that's where all of it, that's where the rubber meets the road with all this information. Tons of great marketing material for you. So with that, Barry, thank you for being on the show. We'll catch you again here pretty soon, okay?
Thanks, everybody. I hope everybody has a great week ahead.
All right, forward, share, subscribe. We'll catch you later here. Leave us your comments down below. Catch you later here at the National Real Estate Post. Bye.
Thanks.